Display the slides?
Yes, I think they are online now.
Okay. Just give me a- Hi, good evening, everyone, and welcome to our three-part series on digital taxation. Yesterday, we had Mr. Bansal talking about the UN proposal on Article 12B. Today, we are going to focus on Pillar 1 proposals, and both for Pillar 1 session today and for Pillar 2 session tomorrow, we are going to have a common speaker. It's Professor Dr. Vikram Chand. He's a professor of law at the Tax Policy Center of University of Lausanne. Vikram is someone who is very well known and is an authoritative voice, even within the EU, very well recognized in India as well. So without much ado, I'd like to welcome Vikram. Today's session is going to be moderated by my IFA colleague, Nilesh Kapadia. Over to you, Vikram.
Thank you, Mr. Rani, for this wonderful introduction. And thank you, Mr. Kapadia, as well as Mr. Budani, for this invite that I have received to express my opinion on the Pillar 1 and Pillar 2 debate of the OECD's digital economy, work on digital economy. So let me just start the presentation right now. And after the presentation, there's going to be a Q&A session. And if people have any question whatsoever, just contact the moderator, Mr. Kapadia, and I'm sure Mr. Kapadia will intervene with the question. And the questions can come in during the presentation as well as after the presentation. I'm absolutely fine with that. So in terms of agenda, what we are going to look at today is we'll just go through the background of the Pillar 1 or the OECD digital economies, Pillar 1 of the OECD digital economy debate. What is the entire issue all about? We will then look into a case study of how the rules will actually work. Then we will look into the features of Amount A, and in this third part, I'll be making a comparison with the UN proposal, which has been flashed out on automated digital services. Then we'll speak a bit about Amount B and the features of Amount B. And finally, we'll conclude with some remarks for the future. So let's start with the background of this entire Pillar 1 debate. The issue is well known, so I'm pretty sure that all of you who have logged in today already know what the Pillar 1 issue is all about. It's about allocation of taxing rights to market countries. But it's still nice to just go through the background, because the background sets the tone for some future debates, especially when we are doing a comparison with the UN model, or the provision that has been put forward by the UN on fees for automated digital services. So in terms of background, how does the current framework actually look like for taxing cross-border business income? Now, if we go back into the past, around 100 years in the past, in the work of the League of Nations in the year 1920s, what was decided is that the international corporate tax base, on at least the base which should be used for the factors that should be used to allocate a corporate tax base to a country, is actually linked to the production factors in a country. Now, like I mentioned to you, this is this was decided sometime 100 years ago. So if you have your production factors in one country, then and you actually make profit from those production factors, then that profit is only taxable in the country where the production factors are present. And this framework has been once again reinforced in the OECD's work on the BEPS action plans. If you see BEPS action plan 5, which speaks about the substantial activity requirement, BEPS actions 8 to 10, which realign transfer profit allocations in accordance with where the activity of an enterprise takes place, as well as if you look into some other provisions of tax treaties, especially the principal purpose test, it's clearly mentioned that treaty benefits should be extended to entities which actually undertake some co-commercial activities. So, this concept of value creation that has been floating around, it's quite a subjective concept, but one thing is for sure, that one meaning of value creation is where an enterprise has its production factors, in the sense that when the OECD says you have to align taxation outcomes with value creation, in other words, it actually means you align taxation outcomes, or you give the countries the right to tax an entity's business income, as long as there are some production factors in those countries. Now, what are these production factors that I'm talking about? Now, the typical production factors are people. It's because people are the entrepreneurs or the employees working in business. They are the ones who are actually using their intellect to develop a business and actually make money out of that business. So if you have a company like Lindt chocolates, I think everybody in India knows Lindt chocolates. So if you have a company like Lindt, which is based in Switzerland, it's a Swiss brand, and if Lindt does all its work in Switzerland in developing the chocolates, then it sells those chocolates to a market country, like, for example, India, then under the current framework, this business income is taxed only in Switzerland. Why? Because the production factors are based only in Switzerland. On the other hand, if you have the production factors in another country, then the other country is also justified to tax that business income. The production factors can be based in another country, either from a legal standpoint. These production factors could be a part of a branch or a separate legal entity. Now, these then the question arises is, okay, so now you're in a situation where you have one head office or one head entity, and this head entity is carrying out business in another country through some production factors. So how do you go about allocating profits to these production factors? Then that's where transfer pricing rules actually come in. The transfer pricing rules that we see right now, they are based on a separate entity concept. In other words, you have a multinational enterprise. Take a big multinational enterprise like Nestle, for example. Nestle operates with 100 subsidiaries around the world, or more than 100 subsidiaries. So this entire multinational enterprise is not treated as a single taxable unit. It is treated, each entity in the multinational enterprise is treated as a separate taxable unit. So transfer pricing inherently relies on the value that has been generated by a separate entity within a group. Now, this separate entity essentially also the principle of separate entity applies equally between subsidiaries as well as branches. So coming back to our example here, so if we have Lindt in Switzerland and it has some value creation factors, let's say once again in India, let's assume that it has a limited risk distributor. These value creation factors, the people are a part of a limited risk distribution structure. And these value creation factors then derive certain income. So from a transfer pricing perspective, this limited risk distributor would be allocated probably around 2 to 3% return on sales. That's what independent comparables would actually earn. Now, similarly, if it was a full-fledged distributor, the amount that would be allocated to the market country would be much higher. It really depends on the business model of the enterprise, of how do you go about allocating profits based on the arm's length principle. In summary, just to repeat and to ensure this point goes well with everyone, because I see a lot of confusion among people when they speak about this. So I just want to make this absolutely clear, is that you have a multinational as a whole, like I explained to you, like Nestle, and Nestle operates with multiple entities around the globe. So there are two ways you can allocate profits to these entities around the globe. One way is you treat every entity within the Nestle group as a separate entity, and then you apply the arm's length principle and transfer pricing rules to go about allocating profits to these separate entities. On the other hand, you treat the entire group as one single entity, and then you allocate the profits of this one single entity among various countries on the basis of some predetermined formulas based on people, assets, and sales. So there are two key approaches which are used to allocate profits of a multinational enterprise among different countries. But the prevailing approach so far that has been used across the world is the arm's length principle and transfer pricing. So the arm's length principle, as you all know, can be found in Article 9 of the OECD model, UN model, US model. And at the same time, it is also found in the context of Article 7, which talks about profit allocation to permanent establishments. If you look at Article 7 of the OECD model 7.2, of the 2010 version, 2014 version, 2017 version, and to a certain extent in tax treaties by even developing countries, there are provisions which essentially say that, if you have a PE, then the PE should be treated as a separate entity for profit allocation purposes. And to a great extent, the arm's length principle also applies in the context of permanent establishments. Now, I know developing countries don't accept the AOA, the authorized OECD approach for profit allocation, but they still have to use some kind of arm's length principle to allocate profits to the Ps, unless and until some exceptions are made in the actual tax treaties. So globally speaking, you use the arm's length principle currently to allocate profits to entities, separate entities, or to establishments within a multinational enterprise, as opposed to global form reapportionment. But what we are seeing right now with the OECD project, which I will allude to a bit later, is that the OECD has stepped away from the separate entity principle with respect to Pillar 1, and it's moving more towards an M&E group approach. It's treating the M&E as a single entity with respect to profit allocation purposes. I'll come back to this on this point. I will come back to this point once again. Like I mentioned too, the entire Pillar 1 debate right now is how do you go about allocating taxing rights and multinational profits to market countries. It's not only about allocation of taxing rights here, the debate, it's about that also, but then you need to have proper, easy and administrable rules to allocate these profits of M&Es to market countries when you give them taxing rights. It is already well known, and in the previous presentations already I've made, the digitalization has had a big impact on the entire economy. And in light of the increasing use of intangibles, some business models collecting tons of user data in order to commercialize, and some businesses which can scale rapidly on the internet. Now, these are the features of the digitalized economy, and these features actually lead to a situation where multinationals can actually centralize their operations in one country, operate without any physical presence or with low physical presence in market countries. In these kind of situations, the question arises is how do you go about allocating taxing rights as well as M&E profits to market-based countries? That's what the entire Pillar 1 debate is all about, is allocation of taxing rights to market countries. Why? Because in the past, whenever a multinational wanted to enter into a market country, it had some kind of physical presence. But nowadays, because of digitalization, the physical presence has reduced, or the physical presence is not really required as a precondition to enter into the market, depending on a multinational's business model. So one way to deal with this issue is just for countries to introduce unilateral measures. Now, India took the lead in 2016 after the publication of the BEPS Action 1 report, and it introduced the equalization levy. The equivalent of equalization levy in the European region are digital services taxes. Not only in the European region, but also many common law countries outside the European region are introducing digital service taxes. The UK or Australia or Canada or New Zealand, they have been contemplating these taxes, as well as many other countries, as you can see in the slide here. Now, these digital service taxes, they actually target only selected businesses. They don't target a broad scope of businesses. They just target selected businesses, especially the online advertisers, as well as some, depending on the country, online marketplaces. I know the Indian equalization levy has expanded its scope recently, and in light of that enhanced scope, India once again stands out as one of the countries which has a broad scope with respect to the equalization levy. A few things here. The Indian equalization levy is quite different from the DSTs, especially the DSTs that are being contemplated in the EU or other common law countries, because these measures in the other countries would apply to multinationals which have more than 750 million of revenue, and then they cross some local revenue thresholds which are quite high. They're on some millions of dollars, the local revenue thresholds. But on the other hand, the equalization levy, I think right now it started with 1 lakh rupees as a threshold, if I'm not mistaken. And now it has a 2 crore, 2 crore threshold. I think so. But Mr. Kapadia, I think he'll be in a better position to explain that. So the thresholds that have been contemplated in the Indian equalization levy are much lower than the thresholds that have been contemplated in the other DSTs. So moving on, so there are differences between DSTs and the equalization levy, but just if I have to give in my own personal opinion here, I think these measures constitute income which are covered by tax treaties. So hence, treaties are applicable to such levies, and because you have tax treaties in place, then the application of these levies should be switched off of tax treaties. I think this is a point which a lot of people have made. This is nothing new, this point. So equalization levies and DSTs are taxes covered by tax treaties, and I think it's only a matter of time before a court intervenes and switches these off. It's just a matter of time. It's going to happen. So if countries are thinking that these are going to become long-term measures, unilateral measures, well, the news is bad for them, I guess, because in the future someone's going to take the case to a court, and the court will rule hopefully in the favor of the taxpayers. Let's see. So that is one option which countries have been pursuing with respect to equalization levies or unilateral DSTs, but that's not the most appropriate way, I would say, to achieve a global solution. So what has happened? So because of these unilateral DSTs and equalization levy, which in a broad scope, a broad-based unilateral measure that was unilateral measures that have been introduced by a lot of other countries. These unilateral measures were creating a lot of complications, and I think unilateralism is not the right way forward. It's actually multilateralism, bilateralism, or multilateralism, but definitely not unilateralism. So the OECD came up with 3 initial proposals to solve this issue at stake. One of the proposals was the user participation proposal, which was backed by the UK and the EU. A second proposal was a significant economic presence proposal, which was put forward by India. And finally, there was a marketing intangibles proposal, which was put forward by the US. Now, it's not the purpose of this presentation to speak about these rules. I would like to speak about the blueprint. So, just to to make the entire discussion very straightforward and easy. The user participation proposal applied to a very narrow set of businesses. Significant economic presence applied to a broader set of businesses, but only digital businesses. And then the marketing intangibles proposal applied to a broader set of businesses. These were the initial proposals, and these initial proposals were combined in one way or another, and this resulted in the creation of a unified approach. Now, the unified approach has 2 amounts, amount A and amount B. Now, amount A is an add-on to the existing system, which is based on M&E group results. Now, at the start of the presentation, I had mentioned to you that when you're dealing with a big multinational enterprise, the current rules of the existing system, which is based on the separate entity principle, treats each and every entity within a multinational group as a separate entity for profit allocation purposes. So profits are allocated to each and every entity based on the value that is being created by that particular entity. But here, amount A moves away from this separate entity principle or the existing framework, and it creates an add-on to the existing framework based on multinational group results. So it is moving towards a system of global formulary apportionment, but the mechanism that has been developed for global formulary apportionment is quite unique and quite innovative, and this is very interesting, what the mechanism that was developed in an amount A scenario, which I will explain to you in the following slides. A separate amount was also introduced, which was amount B, which stays within the existing system, which is based on the separate entity approach. This actually applies to low-risk distributors when they are buying and selling products for resale. And I'll speak to you about this also, the amount B, but the bulk of the presentation is going to be on amount A. Amount B is just a simplification mechanism to improve the transfer pricing system. Why do they want to improve the transfer pricing system in B? Well, now, just one point here. Amount B is an amount which is allocated to distributors. If you take India also as a country, there have been a lot of litigation on AMP expenses, on distributor-related activity in India. Actually, not only in India, if you take US as a country, there's been a lot of litigation on distribution activities from a transfer pricing standpoint in the US as well as in other countries. So one of the proposals is to simplify the transfer pricing system by coming up with some fixed margins with respect to amount B. Now, why was amount A necessary? Why did they have to move away from the separate entity principle? Because you see, to allocate profits in a digitalized to a digitalized business or a multinational that is operating in the digital age today, which is operating in the digital age today, using transfer pricing rules to allocate profits to various countries becomes extremely difficult. It's extremely complex. So as we all know, transfer pricing is not easy. First of all, it is not an exact science. There's a lot of subjectivity associated with transfer pricing rules. So in order to avoid this subjectivity associated with transfer pricing rules, an amount A was designed, which is based on M&E group results. And somehow it's linked to the consolidated financial statements prepared by M&E groups, which I will explain to you. So let's start with a case study. Now, I've used this case study on similar occasions in a previous presentation, but enhanced version of this case study, which will make you understand the nitty-gritties of the OECD Pillar 1 case study. I'm choosing a multinational group which is actually selling physical goods, because for an M&E which is doing ADS kind of businesses, automated digital service kind of businesses, it's very simple. To develop a case study on that front. So I just wanted to develop a case study which is a bit more challenging. So I chose a multinational which is selling physical goods. Now, just to let you know that when you're dealing with amount A, because you need to consider the entire multinational group as a whole, so you need to understand what is the business model of the multinational enterprise. Now, I've taken a business model which is quite common in a lot of multinational enterprises, which are dealing with creation and sale of goods. Now, in this example, let's just assume that we have a US parent. This US parent has developed all the trade and marketing intangibles of the group. And this US parent is operating, which is PICO, is operating as a full-fledged manufacturer for the US market. What does that mean? I think for transfer pricing professionals, they understand the concept, what is a full-fledged manufacturer, pretty easily. So a full-fledged manufacturer is a manufacturer which makes all the key decisions in the value chain, right from innovation, buying, making, selling. And let's just assume that here, Pico is a full-fledged manufacturer in the US and it's making its goods in the US and selling the goods in the US for the US market. Now, for its overseas operations, Pico has set up a principal company, and this principal company is based in Switzerland. Now, this principal company uses toll manufacturers or contract manufacturers to produce the goods, and then these goods are sold in different markets, including Switzerland. One of the countries in which the principal is actually selling its goods is in India, where some remote sales are being made, and and if you look at the current framework, you can say that because remote sales are being made into India, and in India there is no permanent establishment, hence there is no tax under the current framework, no income. But don't forget, India is collecting, when goods come into India, India is collecting indirect taxes, whether it's customs or it's VAT. India is collecting some kind of indirect taxes. On the other hand, let's just assume that this company is selling into the German market and selling into the German market through a limited risk distributor, and this limited risk distributor is allocated a return on sales of 3%. Finally, the principal is selling into the French market. So in France, the principal has a full-fledged distributor to which the principal has licensed some kind of intangibles, like for example, marketing intangibles, the right to use the trademarks of the multinational. And in return, the full-fledged distributor is paying some royalties to the principal. And when you're dealing with full-fledged distributors, typically you charge royalties to full-fledged distributors, but you don't charge royalties to limited risk distributors. You charge royalties to full-fledged distributors. And let's just assume that this distributor is reporting a return on sales of 8%, and this is an arm's length amount post-royalty. Now, when I say return on sales, what do I mean? It actually means very simple. It's your PBT number by sales, or to be more precise, it's your PBIT, profit before interest and taxes number, by your turnover, by your sales. So that's what I mean, return on sales. And return on sales is not something new. It's very, you open the OECD transfer pricing guidelines or you open the UNTP manual, you'll come across a definition of what is a return on sales. It's typically PBIT or EBIT by sales. So in this structure, if you see in India, there's no tax. In Germany, 3% on sales. In France, the profit that is being reported is 8% on sales. On the other hand, bulk of the European profit is being allocated inside the principal because the principal is the residual profit owner. So bulk of the profits are being allocated for the sales that are being made into India and Germany, at least, not in France, because in France is a full-fledged distributor. Bulk of the profits derived from the Indian and German sales that are being allocated to the Swiss principal. Now, let's just assume in our example that the Swiss principal is operating on a return on sales of 20%. It's also selling into, the principal is also selling into the local market and it's receiving money from the local market too. So let's just assume the PBIT by sales figure in the principal is around 20% on sales. And finally, in the parent company, which is the US, it's making the goods and selling in the US market, there's a return on sales that is being reported there of 15%. So let's get into the consolidated financial statements. Now, like I mentioned to you, amount A allocations are based purely on consolidated financial statements or information reported in consolidated financial statements. Now, let's just assume that this M&A is a new multinational enterprise. And for the year 2022, the consolidated financial statements give us this information. Now, let's say the consolidated group operating revenue is around 1 billion. The consolidated expenses of this entire group is around 600 million, which comprises of cost of sales, which is the inventory cost, the R&D cost, selling and distribution costs, administrative costs, interest expenses. You add up all your consolidated expenses, and then you come to a group profits or your earnings before taxation amount of 400 million. Just at this stage, I want to make a difference because when you're applying transfer pricing rules, it's very normal for you to take EBIT figures. That is your earnings before interest and tax figures, or PBIT figures. But when you're applying amount A proposal, you need to determine what is the amount A tax base, and for the amount A tax base, it's PBT or EBT. It's profit after deduction of interest expenses. So financial expenses are taken into account here. So we assume that the group EBT margin, based on the information given here, is 40%. How did we arrive at 40%? So it's group EBT by sales. So the group EBT is 400 million. You divide that by sales of 1 billion, you come to a margin of 40%. We have more information because this entire pillar 1 proposal, it looks from amount A proposal, looks at the situation from a M&E group's perspective, and it wants to allocate profits, like I mentioned to you, to market countries, in other words, where the consumers are based. So this is the information which every multinational will have. It's not a secret. They will have the information they will have to a great degree the information about the countries in which the products have been sold. So let's assume in this case that 10% of this global revenue, which has been reflected in the consolidated financial statements, is coming from India, 20% from Germany, 30% from France, 40% from 30% again from Switzerland by selling to end consumers in Switzerland. And finally, 10% is coming from the US market. So bulk of this profits of this multinational group, they are coming from doing business outside the US. So how does the profit allocation amount work? So we already determined the taxable base. The taxable base, which is up for reallocation, like we've seen, which was up for reallocation was 1 billion minus 600 million, which was 400 million, and the group EBT was 400 million. So in terms of profit allocation, how does it work? Now here it's a bit special because you don't really, you can follow different approaches, but one of the approach which is being used, and I think this is where the negotiations are heading, is to use a 20/10% approach. Now, what does it mean? So under step 1 of this approach, what you do is you take your group PBT by sales. So like you've seen before, the group PBT by sales was 40%. Now, out of this 40%, you say that 10% is allocated to, this has to be decided multilaterally, that 10% is allocated to a routine margin. So if 10% is allocated to a routine margin, then 30% will be allocated to a non-routine margin. Now, out of this 30%, which is allocated to a non-routine margin, this 30% will be split between production-related activities and market-related activities. Now, an 80-20 split is being contemplated here. That's why this approach is called 20/10. So anything above 10% of routine return. So let me rephrase. So 20% of the profit above a routine return of 10%, which is 10% here is the routine return. So anything above 10%, only 20% of that, anything above 20% will be reallocated to the markets. So in our example, we say that the residual return is 30%. And only 20% of that 30% is open for reallocation to market-related activities. So 6% of the EBT margin will be allocated to market-related activities. And in step 3, it's very simple. You just have to compute this amount. So you know that the amount of profits that will be allocated to the market-related activities is going to be 6% of the overall revenues. So 1 billion into 6% will give you 60 million. So 60 million is your amount A amount A that will need to be reallocated to market countries. And actually, this is kind of calculation. This is a kind of calculation which you can do in an Excel sheet. You don't need to you don't need to develop some complicated softwares for this kind of calculation, because you can just do it on the base, on a simple spreadsheet in an Excel sheet, and come up with this number. So around 660 million is your amount A taxable basis, and this will be reallocated back to the market countries in proportion to the sales. So because India is receiving, there are 10% of the global sales are derived from India. India would be allocated 6 million of that profit, and it would have to pay local corporate income tax on this 6 million. And the local corporate income tax is around 30%, so you can do the math. 30% of 6 is around, take a very quick calculation, it will be 2 million of taxes in India. So in Germany, like I mentioned to you, as 20% of the global sales are derived in Germany, Germany would be allocated around 12 million of that profit. So the entire profit was 60 million, the amount A taxable profit. Now the 60 million, 20% of that is being allocated to Germany. France will be allocated also this profit. But here, it's very important to note here that in France, there is already some local operations that are taking place. So the amount A profit that to France is around 18 million. So 30% of global sales are taking place in France. So amount A would be 30% of amount A would be allocated to France. That is around 18 million. But like I mentioned to you, in France, there's already a full-fledged distributor. So there is some full-fledged distribution activity that is taking place in France. Since amount A deals with reallocation of residual profits to market countries, there is this issue that can come up with respect to double counting. Because under the current rules, the profits that are being booked in France are residual profits. Under the current ALP system, current transfer pricing system, the profits that are being allocated to France are around 8% of local sales, which is 24 million. So under the current rules, which are based on the separate entity principle, when the French entity is filing its corporate tax return, it's reporting a profit of 24 million on which it's going to pay local corporate income tax. Now, the amount A allocation to France, because 30% sales are being derived in France, was around 18 million. Now, what's happening here? Now, if you think about it a bit more deeply, under the current rules, residual profit is being booked in France. Under the new rules, which is the amount A, a part of the residual profit is also being allocated to France. So there's this issue of double counting that can arise. That is the same profit being taxed in France, same profit being taxed in France, both under amount A as well as under amount, as well as under the separate entity principle, the arm's length profit allocation system. So what is happening here? So there is an overlap between amount A and the existing profit allocation mechanism. So to avoid this overlap, a marketing and distribution safe harbor is being contemplated. Now, this marketing and distribution safe harbor, it is actually designed without getting too much into details of it, and because I will need more half an hour to explain that. It will be a sum total of amount A plus a fixed return, which we assume is 2%. Now, if the local profit that is being booked in France is equal to or exceeds the safe harbor, then there's no profit allocation under amount A. And actually, we will assume that this is the case here because the local profit allocation is already 24 million in France. Then, then amount A allocation is around 18 million. So the amount that is being paid into France under current profit allocation rules is much higher than the amount A allocation. So hence, there would be no profit allocation in France in this case because there's an overlap. And actually, if you think about it, there's already full-fledged distribution activity taking place in France under the existing rules. So why should they be allocated something additional? On the other hand, if the amount is lower than the safe harbor, then some kind of additional profit could be allocated to France under the amount A proposal. So when you're reading the marketing and distribution safe harbor, it would apply to this kind of situation. So we've spoken about what's happening in India, Germany, and France. But let's say that because the principal is also selling into the Swiss market. Now in Switzerland, the principal is selling locally, and 30% of the global sales are derived from Switzerland. So the profit amount A allocation to Switzerland would be around 18 million. Keep in mind that if a tax is being paid in a market country, here that could be India and Germany, or even in France, assuming there could be a liability if the facts were a bit different, then some entity in the group needs to provide relief from double taxation. So the amount A taxable base in Switzerland as a result of sales in Switzerland is around 18 million. But if you think about it, if one country taxes, another country needs to provide for relief. So there are some tests that have been developed in amount A to determine which entity within the group will provide relief for double taxation. At least in our example, the double taxation so far that has been incurred in India as well as in Germany. Who's going to provide relief for that? Now, there are some tests that the OECD has come up with in its Pillar 1 report. It's known as an activity test, profitability test, and a market connection test. Essentially, in our example, if I apply a combination of all these tests together, it would lead to the conclusion that the entity in Switzerland, which is booking the residual profits from the sales connected with the Indian and German operations, this is the entity that is going to provide relief from double taxation. So you already have an amount A tax liability in Switzerland, which is 18 million, but then you've paid 18 million of amount A taxes in other market countries. So by doing a net off, the tax liability in Switzerland would be zero with respect to amount A. Now, what would happen in a situation where the amount A tax liability that has been paid to market countries is much higher than the tax liability in Switzerland and the amount A liability in Switzerland? So let's just assume for a second that the amount A allocation to Switzerland, amount A allocation to Switzerland is 10 million, and in the market countries is 18 million. So what would happen in this kind of situation? Then you move away from the amount A base and you come back into your regular corporate tax system, your regular corporate tax return that you file, and you decrease the revenue. Against the excess amounts you paid in the market countries against the revenue which you're booking in your existing corporate tax return. Finally, you have some sales that are being made in the US market, and because US market is operating quite independently from the rest of the entire group, but still an amount A allocation will take place to the US, around 6 million, because 10% of the global sales are being reported in the US. So an amount A allocation will take place to the United States. But keep in mind once again that under the current framework, this entity is booking residual profits for the US market. So even if an amount A tax liability would arise, then it's not the obligation of the Swiss company to pay it in the US, it will be the obligation of the US company to discharge this amount A obligation based on the market connection test. There's one open question that arises here is because all activities are being done in the US for the US market, there is a possible application of a domestic business exemption test, because here everything is happening locally in the US market. There's no cross-border activity with respect to the US market. And you have all operations based in the US. So possibly there could be a domestic business exemption test. If that does not apply here, then there's an amount A liability that will need to be paid by the group in the US. With respect to amount B, which is the simplest part of this entire case, amount B applies at the separate entity level, and it will be only applicable for the limited risk distributor that is based out of Germany, because this is the entity that is doing low risk marketing and distribution operations. So post Pillar 1, this is how the amount A allocations will look like between various members of the multinational group. So in India, there would be an amount A allocation. in Germany, there would be an amount A allocation as well as amount B would apply in Germany because you're operating with a limited risk distributor in Germany. So an amount B allocation will also take place. So what is amount B allocation? It's very simple. It's just a return on sales, which is based on the arm's length principle. This already many multinationals, whenever they're operating with low risk distributors, they already submit their local file or master file with, their local files to the local tax administrations with appropriate comparability studies. So usually the benchmarks for low risk distributor, depending on the industry, can be anywhere between 3 to 6%. And this is what is being contemplated in the amount B proposal, which is the easiest part of the entire Pillar 1 package. So in France, what would happen is that because of the marketing and distribution safe harbor, there would be no amount A allocation because under the current existing system, residual profits are being allocated to France. On the other hand, in Switzerland also, there's going to be an amount A allocation because sales are being made locally to Switzerland. But at the same time, Switzerland will have to provide relief for the taxes that are going to be paid in India and in Germany. Why? Because Switzerland's or the entity in Switzerland, QCO, has passed all the tests that have been developed to identify the surrender jurisdiction, such as the activities test, the profitability test, and the market connection test. There could possibly be an amount A for the US market, for the sales made in the US market, but domestic business exemption kind of test is being developed because there's nothing digital about what's happening in the US in the sense that they're not selling cross-border, sale, full-fledged operations are being carried out in the US. So probably there could be an exemption from an amount A tax liability in the US in this example. So that is actually how the profit allocation mechanism would work post Pillar 1. It is important to note that the Pillar 1 proposal comes in with loss allocation rules. So there are some rules that are applied to determine to deal with losses within the amount A regime as well as losses before entering into the amount A regime. So in the previous slides, we had assumed that the amount A allocations would we said that would kick in with effect from the year 2022, from 2022. But let's just assume now that the amount A liability or amount A has entered into effect from the year 2021. And in 2021, this group has been making losses. So the consolidated group operating revenue is 1 billion and consolidated expenses here are 1.2 billion. So the group profits or the EBT is around 200 million negative. So the group EBT margin negative for 2021 is minus 20%. How do you go about determining the loss amount here? That's the question. So how do you determine the loss amount in the year 2021? It's important to determine this loss amount. Why? Because this loss amount can be used as a carry forward amount to set off against the amount A taxable base in the year 2022. So there is an approach known as the profit shortfall approach that is being contemplated. And I will give you an example of how the loss amount will be determined under a profit shortfall approach. The logic is the same. You apply the same three-step method to determine profits, which we've used to determine the profits. You apply the same three-step method to determine the losses. So if you say that the deemed routine margin is fixed at 10% positive, and you have a loss of minus 20% negative based on your group operating results, then your negative margin would be minus 30%. So you move from minus 20% to plus 10%. So minus 20 to plus 10 gives you a percentage of 30%, 30. So the amount that will be calculated is 30. Because this provision would apply equally to profits and equally to losses under step 1. At this stage, I have to mention to you that another option is just to say that it is minus 20% here. No decision has been taken yet with respect to this mechanism. I'm using a profit shortfall approach, which I think makes sense, because if you apply the margin to profits, you should apply it the same way to losses. So we've come under step one that the loss margin is around 30%. So out of that loss margin of 30%, 80% will be allocated to production activities and 20% for market-related activities, which would essentially mean that 6% of the EBT margin will be allocated to the market-related activities, and hence 6% of 1 billion of sales would be your loss amount. So minus 60 million would be your loss amount here. What does this mean? So in the end, if you look at it, in the year 2021, you're operating with a group EBT margin of negative minus 20%. So, but you have a loss. There's no profit in the year 2021. So there is no amount A allocation in the year 2021, but you have a loss of minus 60 million. Now, in the previous slides, which I've used to demonstrate the calculation of amount A allocations. So in the year 2022, we had arrived at an amount A allocation of around 60 million. But because there is a loss that can be carried forward, the year 2021, the loss amount in the year 2021 can be used to set off the profit amount in the year 2022. So the amount A taxable base in the year 2022 would be 0. So no income, no profit allocation under an amount A system would take place in the year 2022. This is a system which we've discussed when the losses were incurred within the amount A regime. Now, what happens for losses? You know, many multinationals, if you take Uber, I think Uber is a loss-making multinational, and it's been making losses consistently over a period of time. There could be losses that a big multinational could have before it enters into an amount A regime. So these are known as pre-regime losses. So let's just assume, sorry, you just 1 second. Yeah, sorry about that. My dad was calling me, I think. So sorry about that. So in the year 2020, let's just assume there were pre-regime losses. And these pre-regime losses, which were incurred by the group, also amount to same. For the purpose of simplicity, let's just say that the consolidated group operating revenue was 1 billion. The consolidated expenses is 1.2 billion. And once again, the group is operating with a loss of minus 200 million. And like we've done the calculation before, the loss amount that would be available for the year 2020 would be 60 million once again. So this is one way to calculate. So I have to say that the rules for pre-regime losses are not yet being developed extensively in the Pillar 1 report. So I've come up with this calculation myself, because the losses that are being used, the mechanism that is being used to calculate the losses in the amount A regime should apply equally to the losses in the which were incurred in the pre-regime era. So the loss amount which can be brought in to the amount A regime for the year 2020 is around 60 million. So essentially, if you look at the year 2020, there was no amount A, there was no Pillar 1 rules that were introduced. In the year 2020, there's a 60 million of loss that can be brought into the amount A regime. In the year 2021, we have a loss once again of 60 million, which is also brought into the amount, which is a loss incurred within the amount A regime. So essentially, in the year 2022, when we have a 60 million of amount A taxable base, this 60 million of loss, which was incurred in 2021 or 2022, could be used to set it off. So in your amount A loss account at the end of the year 2022, you'll have 60 million left, which could be utilized for the years 2023 and subsequently. So that's how the entire Amount A proposal deals with profits as well as losses. So I think there's a great symmetry here because the proposal not only deals with profits, but it also deals with losses. And the losses can be divided into two categories: pre-regime losses and losses within the Amount A regime. And these two losses are somehow contemplated in the calculations, which is, I think, a positive point, because businesses should be allowed to take into consideration their losses when they're determining their net income, which is up for reallocation. Now we are moving to the features of the Amount A regime, because I've just given you an example as it's applicable to a consumer-facing business. So when you look at the conceptual base to design Amount A, because I've heard in a lot of occasions that Amount A is not principle based. There are no principles to design Amount A. Well, to a certain degree, you cannot always design a tax system based on hard and fast principles. I think one of the principles when you're dealing with international when you're dealing across the border is also, the principle of political negotiations. This is a principle which is not really taken into consideration in any of the principles. But if you look at what has happened in the 1920s also, it was a lot of academics in the US, they've come up with this statement that whatever happened in the 1920s is a compromise. And what's really happening in 2020 is also going to be a compromise. And in fact, if you look at the Amount A proposal, it's very interesting to note that the Amount A proposal draws its features from all the three proposals which I've mentioned before: the user participation proposal, the marketing intangibles proposal, as well as the significant economic presence proposal. Contrary to everyone's belief, this Amount A logic is not based on the principle of value creation. It goes beyond value creation. It's nothing to do with value creation here. And Amount A also takes into consideration the developing countries' perspective. And you see, because developing countries say that the international corporate tax base should be divided on the basis of supply as well as demand activities. So this Amount A proposal takes into consideration the ideas put forward by developing countries. Now, let me give you another example. If you take the user participation proposal, the user participation proposal applied only to a narrow set of businesses. If you take the US marketing intangibles, if you take the US marketing intangibles proposal, the US marketing intangibles proposal was applied only to B2C situations where the consumers were the end customers, where individuals were the end customers. It did not include cloud computing companies. Cloud computing companies were not a part of the user participation proposal. They were neither a part of the marketing intangibles proposal, but cloud computing companies were a part of the significant economic presence proposal. So in the significant economic presence proposal, cloud computing companies were covered. And if you see the Amount A allocation, it applies, or the UN proposal, it applies to ADS businesses, automated digital service businesses. Now, the fact that cloud computing has come in here, because cloud computing is done mostly B2B, it's not done anything, there's no B2C element, or maybe it's done B2C in some situations, but majority of cloud computing businesses are B2B in nature. And hence, by including some B2B businesses within ADS category or CFB categories, a compromise has been struck between the various views that have been reflected in the public consultation. And one other element that has been drawn out from the significant economic presence proposal is the fact that a formulary approach should be used for profit allocation as compared to the arm's length principle. Because if it was left to, I think, only developed countries, they would try to use the arm's length principle for profit allocation. In fact, within the EU, when a proposal had been introduced on significant digital presence, they wanted to make some kind of amendments to the arm's length principle for profit allocation to significant digital presence kind of permanent establishments in the EU. So here, we are not here speaking about allocation of profits based on the arm's length principle. We are speaking about allocation of profits based on a predetermined formula. That depends from multinational group to multinational group. Its calculation. But at the same time, the amounts are fixed in terms of the routine return as well as the residual return. The base amounts are fixed. Whereas on the other hand, if you look at the UN proposal on digital services, so now this is where I'll start making a comparison between the UN and the OECD proposals. Now the UN proposal is purely based on a supply and demand dynamics. Well, this supply and demand dynamic has also been taken into consideration.
Vikram, can we take a couple of questions here if you, because the example which you explained was quite comprehensive, but there are a few questions which have come on that. So
yes, one.
Take a short break because the comparison is also going to be a very interesting aspect. One question is this 10% which you mentioned as the starting point, as agreed upon by the multilaterally. Now, is it going to be agreed upon on a case-to-case basis or country-by-country basis, or what do you mean by multilaterally?
It will be agreed among all the members of the inclusive framework, and this will be something that will be put forward, and everyone has to give their approval for this. So this is something which will the numbers. This is one of the areas where a decision has not been taken, and this is clearly put across in the Pillar 1 report also. I've used 20/10 as an example, but it could end up being a 30/10, 40/10, 50/10. It all depends on what the entire inclusive framework sits together and they decide on the numbers.
But that 10% will it be across the board for all types of industries, because the profitability is not the same in all industries. Some companies may have, some industries may have 10% as a benchmark. Some companies may have a different number. So how does it actually pan out in reality?
Well, actually, here the idea is that the amount of routine return would, like 10%, which I had mentioned, would apply across across all the industries. But like once again, no decision has been taken, so possibly there can be some kind of differentiation for digital businesses. For digital businesses, they could possibly 5/50, 50/5, or sorry, 50% over 5%. So these decisions have not yet been taken as yet.
So it looks a bit challenging to expect some agreement on this, because each country will try to say that that profitability is high in my country, or something on those lines.
Yeah, so that this is open for negotiation. So that's the reason I think that India should play an active role here, and they should try to negotiate higher reallocation amounts for market countries. And this was actually, I was going to say this in the end, but everything is right now. There's no decision on this parameter that has been taken.
No, means one would like to say that 100% of profits comes in my country, but no other country is going to agree to that.
Yeah, so when you make your negotiations, you have to be a bit more, you cannot just say everything should belong to me, you know, you have to give up something at some point in time when you're entering into a political negotiation. It's actually, if you look at the rates, if you look at fees for technical services, it's 10% withholding tax in developing countries. If you take, you know, interest and royalties, interest and dividends article, a 10% rate was agreed. A 10% rate was agreed for interest payments. For dividends, it was 5 or 15%. Source country taxing rights. So probably here also there has to be some kind of agreement.
Nilesh, you'll have to keep your voice on mute.
So the message here is that it's open for discussions right now. Whether it should be 10%, whether it should be 15%, 20%, 5%, it's all open for negotiation. The inclusive framework, I think there's a drafting group in the OECD who's working on the Pillar 1 proposal, and the drafting group is comprised of developed and developing countries. So this drafting group will put forward certain numbers, and these numbers are reflected in the Pillar 1 report also. It's not something new. These numbers are, the Pillar 1 report has given a range of numbers, what would it be with respect to reallocation, whether it's going to be 20 over 10, 30 over 10, 40 over 8, 40 over 7. So all these numbers have been given in the Pillar 1 report in a comprehensive manner, and the table is set right now for negotiation. So developing countries as well as developed countries, they should sit and they should negotiate on this. I don't know if that answers the question.
Yeah, it does. And I think looking at the clock, I think you can continue rather than take more questions at this stage.
Okay, all right. So I will continue with the comparison right now. So when it comes to comparison, like I had mentioned to you, the UN Amount A actually draws down from elements of all the three proposals which were there initially. But on the other hand, the UN proposal is clearly based on the supply and demand logic. It does not really take into consideration the views of the OECD member countries. And also the UN proposal stays within the existing separate entity framework as opposed to the M&E group approach. Somehow some references are being made to M&E group approach. When a separate entity belongs to a group, to a M&E group, then you use M&E group results to determine the net approach for the purposes of the UN proposal. But the key point here is that the UN proposal does not really take into consideration the views of OECD member states, whereas the OECD's Amount A proposal takes into consideration the views expressed by developing countries. Moving on, as we all know that the Pillar 1 proposal will apply to, as a start, at least as a start, let me emphasize this, as a start, it will apply to M&E groups which exceed a revenue-based threshold, consolidated revenue threshold of 750 million. This approach, like I mentioned, it could be a phased approach. It can start with large M&Es and then it can actually trickle down to smaller M&Es over a period of time. And this is clearly highlighted in the Pillar 1 report. At the same time, if an offshore in-scope revenue threshold is being developed, which would make sense because if you have one M&E which is deriving 99.99% of its business only from one market in which it's headquartered and 0.1 business from the rest of the world, then it does not really make sense to apply the Amount A threshold to these kind of M&Es, where majority of their revenues or profitability is derived from the market in which they are headquartered. So there is an offshore revenue threshold that is being developed, which makes absolutely perfect sense. The proposal in terms of scope would apply to businesses, as you all know, which are ADS businesses. So the common examples are online search engines, social media platforms, marketplaces, streaming services, gaming, cloud computing, online advertising, standardized teaching, so on and so forth. It will also apply to consumer-facing businesses. Now, consumer-facing businesses are typically businesses that generate revenue from the sale of goods or services to individuals. Businesses that will be covered here is personal computing products, clothes, toiletries, cosmetics, luxury goods, branded foods. You take franchise models, McDonald's, Subway, automobiles, all the big ones, BMW, for example. So you have all these big consumer-facing businesses, Procter & Gamble, Johnson & Johnson, all the big fashion brands, Louis Vuitton, Gucci, Armani, everyone will be covered by the scope of this proposal. There are some carve-outs, and these carve-outs also make sense, because the carve-outs are actually can be divided into two broad categories. They actually involve businesses which have substantial physical presence in market countries, or they are businesses which do not really sell consumer products do not sell consumer products, or they have special rules, tax rules. If you take extractive industries or infrastructure businesses, then you have a mine in another country, or when you have to build a building in another country, then you need a lot of substantial physical presence in these other countries, the market countries. So they are excluded from such amount A proposals. At the same time, commodities, when you're buying and selling raw materials and commodities, they would be outside the scope of this proposal. So if you take big big commodity trading companies like Glencore, for example, they will be out of scope, or at least some business lines of Glencore. Shipping and airline companies will be outside scope, because you see under Article 8, there are some special rules that apply to shipping and airline companies, as well as financial services will be outside scope, at least selected business lines of financial service companies, because, when a foreign company has to open a bank, even in India, you need to have some physical presence in India, or as well as in other countries in which you operate. So when you already have physical presence in market countries, then you would be carved out of the scope of this proposal. So that's the logic for the exclusion for financial services business. Now, in comparison, if you take the UN proposal, the UN proposal only applies to ADS businesses. It does not really apply to consumer-facing businesses, and it applies only to ADS businesses. So any revenues which developing countries could actually get as a result of CFB businesses, and this could be quite a lot. So don't underestimate how much consumer-facing businesses actually sell in developing countries, because developing countries have huge consumer markets. At least if you take Brazil, Russia, India, China, they have huge consumer markets, and these consumers, they buy a lot of goods. And the UN proposal does not really tackle or does not apply to CFB businesses. And at the same time, the UN proposal does not apply to, it applies to all MNEs, and there are no revenue thresholds that have been designed in the UN proposal. Now, what does that actually mean? So if there are no revenue thresholds, so this essentially means that if you have a company, let's just take, for example, Netflix, and Netflix is selling its streaming services into 100 different countries, then it will have to go and file, it has to take registration in 100 different countries to discharge its tax obligations, even if they have even $1 of revenue or 5 rupees of revenue. They will, of course, some local revenue thresholds will be developed. You have one multinational group which will have to comply with different revenue thresholds across the world for the countries in which it operates. So the cost of compliance of the UN proposal, at least from a multinational's perspective, is quite high, as opposed to the Amount A proposal, where under an Amount A proposal, the multinational will have to deal with its home state tax administration, as well as a panel of other tax administrations that will be set up. And then this panel will decide on how the Amount A allocation should take place, and the Amount A allocation would take place. So the UN proposal actually, for a global multinational ADS kind of business, it raises significant compliance costs with respect to its implementation. At the same time, from a nexus standpoint, a proposal has for automated digital services, so there are global revenue threshold. So if you take a company like Google, so Google will be in scope because it has more than 750 million consolidated revenue, and Google will possibly be in, will have to pay Amount A taxes in a particular country if it crosses a local revenue threshold. And the local revenue threshold is actually is only a requirement for ADS businesses. And for consumer-facing businesses, a local revenue threshold is also being developed with respect to sales being made into a market. So, for example, if Google sells its advertising services, or it has users which view its advertising services in a particular country, and that exceeds a certain local revenue threshold, if I'm not mistaken, the threshold that is being contemplated in Pillar 1 is 1 million for ADS businesses and 3 million for consumer-facing businesses. So if the local revenue thresholds are crossed, then there would be nexus in a country. And then if the nexus threshold is met, then an amount A allocation will take place to that particular country. There would be possibly a temporal requirement that will be built into the nexus rules. Now, just try to compare this rules to the existing permanent establishment rules that you have, because under the existing permanent establishment rules, like you've seen in India, substantial litigation takes place on the concept of P under Article 5.1, 5.3, 5.5, or whatever it is. So a lot of litigation takes place around these concepts because these concepts are quite subjective in nature, the entire P concept. So here they just want to have a local revenue threshold test, which essentially says that you cross the local revenue threshold, and then you create nexus in a particular country. You don't have to determine whether there's a fixed place, whether there's a degree of permanence of this fixed place, whether the place is at the disposal of the enterprise. You avoid all these kind of things. At the same time, for the UN proposal, there is, as we all know, there is no M&E group revenue threshold. It applies across the board, and at the same time, there's no local revenue threshold that has been proposed. Probably it will be proposed as a part of domestic law, but no threshold has been proposed at the level of the tax treaty itself. With respect to profit loss amount, like we have seen, we need to determine the taxable base, the amount A taxable base using consolidated financial statements. Now, in the consolidated financial statements, you would mainly have to deal with your P&L of the consolidated P&L, and you'll have to make some adjustments both on the income side as well as the expense side. On the income side, probably you'll have to remove some extraordinary gains or items attributed to some one-off events, and on the expense side, you'll have to remove, for example, if you pay some bribes to someone, you'll have to reduce that. Or some other kind of expenses, but the amount of adjustments that will need to be made to a consolidated P&L are not. Sorry, 1 second. Sorry, I put my phone on silent. I'm sorry, I put my phone on silent. It's ringing again. Sorry for that. So. So you, on your consolidated P&L, you'll have to make some kind of adjustments both on the income and expenses side, but the adjustments, they're kept to a minimum. Now, if you have a M&E group which has various business lines, in this kind of situations, the proposal only contemplates that segmentation can be allowed. If you have many in-scope business lines, segmentation can be done. Only if you cross some kind of X billion of revenue. When you have a multinational more than 750 million, but for example, less than 3 billion of revenues, segmentation will not be allowed for this multinational. So if this multinational has many business lines, then your consolidated group profit margin will be the profit margin that will be allocated to the business line on a safe harbor basis. And when segmentation is actually allowed, issues could arise. We all know when you're doing, like for example, when you're determining under the arms, suppose there's a contract manufacturer in India, and the contract manufacturer has two kind of businesses. One is it's providing services to its related parties, and another kind of service it's providing to unrelated parties. Then also you would do segmentation for this contract manufacturer to see what its profit margin is with respect to dealing with independent parties, what its profit margin is to deal with related parties. So here also segmentation can arise, but like when you're doing segmenting, of course there's some issues, especially how do you go about splitting common costs. Probably common costs could be split on the basis of revenues to each segments. And like we've already seen in the example, detailed rules are going to be developed with respect to take loss into consideration, both pre-regime losses as well as losses incurred within the amount A regime. Now, it's very important to take into consideration the losses, and the example that I gave, I know it may look a bit too easy the way I've presented, but there are some kind of issues associated with determining the loss amounts, but that can be done. It's not so complicated determining the loss amounts. Whereas on the other hand, if you take the UN proposal from an income or a profit allocation standpoint, the UN proposal proposes a gross withholding tax of 3 to 4%, of gross withholding tax of 3 to 4% on payments that have been made out of a developing country. And at the same time, it proposes, as you all know, a net approach. For the gross withholding tax, I will come back to it. But for the net approach, if you look into the commentary on the UN proposal, no detailed rules have been provided for profit determinations or segmentations. There were neither any rules which provide for pre-regime losses or losses incurred within the regime itself. So the UN proposal does not provide any rules for dealing with losses. And the calculation of the net mechanism in the UN proposal is somehow open-ended. It can swing, it can go different ways. So essentially, you may say that, okay, if you are calculating a net mechanism under tax treaty rules under Article 6 or Article 7, that is also left to the domestic law. But if it is left to the domestic law, and if a big multinational has to calculate its net amount, and which could be quite different from national law to national law of various countries, you clearly end up with a compliance nightmare for multinationals, because they'll have to look into the domestic law of each and every country and see what is the net approach under the UN proposal. So it's going to lead to high compliance costs. So apart from the UN proposal not being neutral in the sense it applies only to, it ring fences the digital economy, it's a non-neutral proposal. It comes with a significant compliance cost associated with it. Now, in terms of profit allocation under Amount A, this is a three-step approach, like I mentioned to you, and these three-step approach have some kind of fixed percentages allocated to them. And these fixed percentages, indication is given 20/10. But in the end, if developing countries wish, they should really, if they want, they can go for higher income allocations, 25/10 or 30/10 or 30/5. So this is open for negotiations. So it all depends on what the end negotiations will actually look like before we come to any conclusions of how much revenues will Pillar 1 actually raise. So there is a nice profit allocation mechanism, a three-step approach that has been devised. But when it comes to the UN proposal, the UN proposal allocates actually even routine profits to market countries of a multinational. And there could be many situations where a multinational is already booking routine profits in the local country. And somehow this could be seen as a bit of, at least in some academic literature, it has been considered to conflict with the source principle as well as some kind of economic principles. So the UN proposal is in the fact that routine profits are also allocated to a jurisdiction where there are no people or there are no assets is somehow not seen well in from an economist standpoint. This is very interesting right now. I'm sorry, I know I've overtaken the time that has been allocated for this presentation, but I'll quickly sum up with giving you some interesting examples. We can start with Amount A, which deals with the revenue sourcing. Just to show you a comparison between the UN and the OECD proposals. And under the OECD proposal, detailed revenue sourcing rules have been developed for ADS businesses as well as for CFB businesses. Whereas for the UN proposal, the revenue sourcing rule is very simple. It's like a very simple rule which says that we allocate ADS revenues to payers' location. Now, in many situations, developing countries will not be able to obtain tax revenues from highly profitable ADS businesses because of this sourcing rule. So the Amount A proposal has detailed sourcing rules for ADS and businesses. The UN proposal has a very simple sourcing rule. And this simple sourcing rule actually is not really in the interest of developing countries, because in many situations, MNEs will not be countries will not be able to tax multinationals. If you take this simple example here, we have an online advertising kind of business. You have already, you know how the business models operate for online advertising. So let's just assume that we have a business client, and the business client is making a payment to Instagram, Facebook, or to Twitter, or to, and these payments are being made to, let's say there's a German client making a payment to Instagram, Facebook, or Twitter, or to Google for advertising services. And these advertisements, let's say BMW, the advertisements of BMW will be advertised on many user countries, user countries. So here, let's say that advertise. So let's just, to make the example more simple. So we have a German company which is paying Google for advertisement services for ads to be displayed to Indian users. In this kind of situation, under the OECD proposal, India would get an amount A allocation, but under the UN proposal, India cannot tax. And this is a bit surprising for me, because the value of these businesses is also linked to users. But under the UN proposal, India cannot tax. Under the UN proposal, Germany can tax, because the rule is linked to the payer of the income. So in this kind of situations, and actually this in many developing countries, is actually non-residents. I read an article somewhere which essentially said that a lot of non-residents enter into contracts with other non-residents to display advertisements to developing countries. And because there's no payment that is being made from a developing country, the UN proposal fails here. India cannot tax in this situation. And this is a bit unfortunate in this example. In another example, if I move to an online marketplace example, suppose we have some individual who are living in Switzerland. They use Booking.com, and they use Booking.com to rent, they want to visit the Taj Mahal, and they book a hotel, they book an Oberoi property near the Taj Mahal, and they come and they visit Taj Mahal. So now from Booking.com's perspective, because Booking.com has more than 750 million revenues, at least pre-COVID. I don't know what happened after COVID. But if you take a big company like Booking.com, it has substantial revenues, commission revenues, which it receives. So from Booking.com's perspective, under amount A, it is subject to amount A, assuming all the thresholds are passed, then amount A would be allocated to both jurisdictions here, both India as well as to Switzerland. Whereas under the UN proposal, India cannot tax again. And this is once again a bit surprising to me. Why India cannot tax? Because here the payer of the income is based in Switzerland, not in India, even though the underlying service is being consumed in India. So India cannot tax in this kind of situation because the payment is not being made from India. Actually, where the UN proposal also fails is in respect to B2C. In all the examples that I've given so far, there was a B2B and a B2C element. But to crystallize this point, you have a B2C. If you take, for example, Netflix, or you take LinkedIn Learning, and you have, let's say, individuals which are based out of India. And these individuals will have to, they go online and they get access, they make a payment, and they get these services from Netflix as well as LinkedIn Learning. So in this kind of situation, under amount A is clearly allocated to India, so India can tax. But on the other hand, if you look at the UN proposal, India can tax under this situation, but from a practical standpoint, you cannot really ask individuals to start withholding taxes. So the gross-based withholding tax, which is applicable for 3%, actually fails here, because in a B2C scenario, individuals cannot withhold tax. So my dad, he lives in Hyderabad. he has a Netflix account. You can't ask my dad to withhold taxes on the payment he's going to make to Netflix, right? That's not going to happen. So as a solution, what is the alternate solution? So if individuals cannot withhold, what is the solution here? So if you look into the commentary, it says, okay, we shift the burden on financial intermediaries. Now, good luck with that. It's not going to happen. You can't just shift the withholding tax burden on financial intermediaries here. Because if you just think about it, if these individuals in India, they have a bank account in India, then the bank, let's say State Bank of India, it will have to look into every payment that has been made by this individual, whether it's going to be for an ADS business, in order to collect the tax. It's not going to happen. So it's very simple to say we'll shift we'll shift the collection burden on financial intermediaries like a bank, because you make the payment from your bank account or from your credit card. We can actually shift the financial burden on to a bank or to a credit card company, but that's not a practical solution for collection of taxes. Well, you can easily say then we have a self-assessment. We can do assessment basis. But the question then arises is, will SMEs, because SMEs also covered by this proposal, will they self-assess? Maybe the big companies will self-assess, but a lot of companies, they may not self-assess. So there's no guarantee of revenue collection. So revenue collection is indeed a challenge under the UN proposal. So it's very easy to say we'll have a gross-based withholding tax of 3 to 4%. That is a very easy solution to implement. But if you look at most examples that are given, all these businesses are B2C. In B2C, the withholding tax fails. So, so what is actually left then in B2B businesses? If you look at B2B businesses, which will fall within the scope of the UN proposal, the B2B businesses which will be there are typically payments for cloud computing or payments for online advertisement from India. So you will have a gross-based withholding tax only for these two kinds of companies. It will be a self-assessment basis. So my question is, why do you want to have the withholding tax at all? Why don't you just propose something which is on a self-assessment basis instead of having a withholding tax? Because the withholding tax will apply only mostly to B2B situations. And the B2B situations are cloud computing payments or online advertisement payments made by businesses. So there are many issues with the UN proposal, so I don't think this has been really thought through in the gross withholding tax approach, because it fails in a B2C context. In terms of jurisdiction, like I told you, the Amount A proposal, in general, under the Amount A proposal, within the multinational group that will have to provide relief from double taxation are typically the entities which are booking residual profits. So a series of tests have been provided, like the profitability test, market connection test, activities test, so on and so forth. So in a multinational context, these relief will be provided by entities, depending on the business model of the multinational. But typically, centralized business model, the centralized entrepreneur will provide for the relief. Centralized IP model, the owners will provide for relief, whereas in a decentralized model, the local entrepreneurs will have to provide for relief. Methods that are being contemplated to eliminate double taxation, well, they are the exemption or the credit method. Now, the UN proposal, the way it has been written, especially when an entity belongs to, there could be a situation, there could be it's a very possible situation where at a separate, you say one entity within the multinational group is making sales into India. At the separate entity level, the entity is making whereas at a mini group level, it's making profits. So in this kind of situation, the question arises is, how do you calculate the net mechanism, and to which entity will you allocate the responsibility to provide relief from double taxation? So because the UN proposal follows the separate entity logic, there could be situations based on the wording. The wording is a bit open-ended, that possibly loss-making entities could also be allocated the burden to provide relief, which again does not make any sense at all. Then you move to the tax certainty component, the big tax certainty. I know the report is big; it's around 240 pages. So, and there's a reason for that, because they want to provide detailed guidance on various aspects of the rules on scope, nexus, profit allocation, surrender jurisdictions, revenue sourcing rules. So, detailed guidance is provided on these kind of rules. With respect to dispute prevention, it has a huge dispute prevention component associated with it. The Pillar 1 Amount A proposal using some panels, and these panels will be made up of tax administration of many countries. So the OECD Pillar 1 proposal actually encourages tax administrations in tax matters, which is a good point. Which is not a bad thing; it's a good thing. Where all tax administrations, they can sit together and actually assess M&E's taxable amount A taxable basis. And at the same time, for on dispute resolution side, some mandatory binding dispute resolution mechanisms are being proposed. If I make a comparison once again with the UN proposal, there's no tax certainty component. The way the provision has been written and the commentary has been drafted, it raises a plethora of issues. I've just highlighted a few, but there are many more issues which would arise. And because of these issues, the UN proposal is a proposal which enhances tax uncertainty. It does not really lead to tax certainty. Now, the UN proposal also stays within the existing framework. Now, what does it mean? Now, under the existing framework, there is no dispute prevention mechanism unless and until you follow the national mechanism. So there's no dispute prevention mechanism at the global level, but for dispute resolution, you have the mutual agreement procedure. And the mutual agreement procedure, in some countries it works very well, in some countries it doesn't work. And as we all know, under a mutual agreement procedure, the competent authority should endeavor to resolve the dispute, but there's no obligation for them to come to a final settlement. That's where arbitration has been proposed, but arbitration is something which developing countries don't like, and I agree with that. It does not. Why should a country give up its sovereignty? But the issue here is that the UN proposal on digital services is no tax certainty component associated with it. If you look at the Pillar 1 proposal, there's a component on dispute prevention and a dispute resolution component, which has been developed in the Pillar 1 proposal. Also, the proposal, by being under the current framework, you'll have the same old issues, whether a receiving entity is a beneficial owner or not. How would you deal with income characterization issues, whether the income, whether it's royalty income, whether it's technical services income. The same old issues, same old disputes, and same old issues, same old disputes, in addition to the disputes associated with the way the provision has been worded, as well as the commentary on the proposal. From an implementation standpoint, the amount A is purely based on a multilateral approach, in the sense that there will be some domestic law changes that will have to be made, and a new multilateral convention will have to be developed, and it promotes multilateralism in matters. Whereas on the UN proposal, it's within the bilateral framework of negotiations. And my question actually would be to the proponents of this proposal is, what are the chances of OECD member country actually agreeing to this proposal in light of all the challenges? I don't think the OECD countries are going to agree to any kind of UN proposal. So then what's the use of just introducing it in your national law, where from a tax treaty standpoint, you'll be restricted from actually applying this proposal. Now, the Amount A proposal comes with detailed guidance and detailed implementation mechanism on how the will be reported and shared among all the countries. Whereas the UN proposal, there's no documentation package which has been payment of taxes. Very interestingly, one-stop shop kind of mechanism is being contemplated under the Amount A proposal, which taxes will be paid to the parent company's tax administration, and then the parent company's tax administration will guarantee the distribution of taxes to other countries. Whereas the UN proposal have to register in each and every country, like I told you, in B2C scenarios, best of luck. You can just expect the companies to register, but there's no guarantee that these companies will actually register. So then that brings me to the economic assessment side of the OECD Pillar 1 proposal. From an economic assessment standpoint, some figures have been put across by the OECD, but in combination with Pillar 2, the proposals seek to raise substantial corporate tax revenues for all countries. So I think in the Pillar 1 proposal, if I'm not mistaken, it's anywhere between 12 to $24 billion of income. Coupled with Pillar 1 and the GILTI, it can go up to around $100 billion of income. I will come back to you on these figures maybe tomorrow. No kind of impact assessment done by the UN with respect to its proposal of how much revenues it will be raising for developed or developing countries. So it's just like an in-the-air proposal, which has not been backed by a solid economic assessment. But when you read the OECD's economic assessment, there's a 250-page report on economic assessment, which says clearly what is going to be the benefit of this Pillar 1 proposal. Whereas on the UN proposal, there's no economic assessment that has been done. So just to make a very quick comparison between the UN proposal and the Pillar 1 proposal, there are many issues which I've identified in this slide. I will not go through this. Maybe if somebody wants, they can read it. Slides are distributed to them. But with all the issues that arise in the UN proposal, my question would be very simple, and maybe Mr. Kapadia or Mr. Bhutani, you can give me your presentation. Is it really in the interest of developing countries? That's the kind of question I'm trying to raise, because the UN has been a platform to raise the voice for developing countries, but because of all the issues in the proposal, the question arises is it really in the interest of developing countries? I don't know at this stage. There was no assessment done, but because of, in light of the various issues that I've just put forward in this presentation, the UN proposal, seems not really in the interest of developing countries. I'm sorry to say that, but that's how it is. When you look at the various issues that it raises. From an amount B standpoint, well, I know I've exceeded the time which was allocated to me. So sorry for that, but I didn't anticipate the presentation to take place for such a long time. But quick, know that it will apply to low-risk distributors which are based in a country, and some transfer pricing distribution regimes. Some jurisdictions have been used to develop the amount B guidance. So a positive list of activities has been given, as well as a negative list. And essentially what is being contemplated here is that a fixed percentage will be proposed. Fixed percentage will be proposed, and this fixed percentage will be used to allocate profits to low risk distributors, and it can be rebutted or it cannot be rebutted. Some decisions have to be made here. And this proposal can be implemented, amount B can be implemented by just making changes to the OECD transfer pricing guidelines. Why? Because somehow this is in compliance. The amount that will be proposed will be compliant with Article 9. On the UN proposal, actually, it does not really speak about B. But on the other hand, the UNTP manual, if you look at the UNTP manual, no simplification mechanisms have been proposed in the UNTP manual in light of the entire digital debate. Some general stuff is there in the UN transfer pricing manual on safe harbors, on APAs and all this kind of stuff, but nothing concrete in light of the OECD's digital debate on how do you simplify the transfer pricing system. So simplification of the transfer pricing system and the arm's length principle is something which the OECD is well aware about, and a lot of work has been done in that area, and this can be shown by amount B, whereas in the UN, nothing has happened till date on simplifying the arm's length principle. From a conclusion standpoint, to express my own personal opinion here, is that the Pillar 1 proposals, they are something new. To be honest, they are not so complicated if you have a very good understanding of business models, of multinational business models, and how being allocated under the existing transfer pricing system. It's not so complicated. Huh? I'm being very honest here. It's not as complicated as you think you are. The report, as you think it is, because the report is 250 pages. Now, just because the report is 250 pages does not mean that it is complicated. It is not complicated. It just follows the multinational logic. So it follows the top-down approach. So if you are dealing with a multinational enterprise, you need to look from the top to down. And once you look at from a multinational enterprise from a top-down perspective, and you see how the business model works, then understanding how the profit will be allocated would be still, you would require to do some work, but it's understandable. The system is not as complicated as people say it is. This is what I was explaining Mr. Kapadia also at the start of the presentation. When I had my first cell phone, when I bought my first cell phone, I didn't understand many of the features of my new cell phone. It took time for me to understand it. Once I understood it, I have embraced the cell phone and I've kept it with me. So it takes time to understand the Amount A proposal. It's a long proposal. It's very well detailed, well thought about, well fleshed out. So it's a good proposal out there. So what I think is that, of course, there are going to be some technical issues, like with any other new law. If you take the Indian Equalization Levy 2.0 also, a lot of commentators have contemplated or have commented on that there are many issues with the new Indian Equalization Levy. But it's like with any law or any new proposal that you put out there, there are complications going to be there, but solutions and simplifications can definitely be found. I personally feel that the Pillar 1 proposal sets forward a solid framework for multilateral negotiation. Now, I'm a firm believer of multilateral corporations, and Pillar 1 proposal puts forward a multilateral framework for discussions. And I think developing countries should actively participate in this proposal. And if they want to have higher income reallocations, they should be loud, they should speak out, and they should say that, a 20/10 will not work. Maybe a 25/10, 30/10 kind of proposal would work. So that's the end of the presentation from my side. I just want to end off on one note, is that here at the University of Lausanne, we are organizing a profit allocation conference under the separate entity approach, as well as the new Pillar 1 approach. And this conference is going to take place on January 21 and 22, and it's going to be a Zoom online conference. Registrations for this conference are open. We have fantastic speakers in this conference, and we are going to talk about a lot of issues in this conference. So if you feel free to register for this conference, it's free for everyone. And at the same time, we have an executive program in transfer pricing, which we offer at the University of Lausanne. We still have a few spots left in our program, which is beginning in February 2021. And if you want more information about this program, just log on to the link here. And with this, I would end my presentation.
Thank you, Vikram. Vikram, before I hand it over to Nilesh to take us through the question and answer, I just will ask one question, and then I will exit because I had budgeted time only until 8:15. But thank you very much for the lengthy presentation. It certainly worked out well. Vikram, can you share with us as to what is the time frame on Pillar 1, Pillar 2 debate, and what in your knowledge is an indicative date as to when it will be known to people whether the discussions are ending into a deadlock kind of a situation, which is what the situation was, early this year, or there is some form of a consensus, and which direction will it take into? Because most people believe that in order for Pillar 2 Globe proposals to fructify, there is a lot of work in progress and the entire energies are devoted to Pillar 1. Thank you.
Well, so as you all know, there is this, there was some questions that were highlighted to the public for the public consultation. So everyone can comment on these questions by the end of next week, I think. And then there's going to be a public consultation in January. And I think by next June or July, there's going to be some kind of agreement on various parameters of the proposal, especially like Mr. Kapadia, which I mentioned before, on the routine amount or the residual amounts. So there's going to be some kind of indications that will be given to us, or what these 20/10 or 30/10, what it's going to look like. So once all those negotiations take place, then I think by the time the entire proposal is flushed out, assuming it is successful, all the negotiations are successful, by the time the entire proposal comes out, then it's actually implemented in the national laws. So you're seeing somewhere 2024, 2023 or 2024 actual implementation.
Thank you, Vikram. Over to you, Nilesh.
So there's time for everyone to learn about Pillar 1 and Amount A.
Nilesh, you're muted.
Thanks, Mukesh. And I was just thanking Vikram for a very extensive exposition on the Pillar 1, and it has at least made me much wiser than what I was at the beginning of the session. Questions do remain about the negotiations and whether they will ever succeed, and whether, like it was mentioned, that even the OECD countries may not agree to the UN suggestion. So maybe the UN, the developing countries may not agree or find a common meeting ground for the bilateral negotiations. Only time will tell that. But at least you explained us in great detail. And looking at the clock, and I'm sure there are many participants who are also like Mukesh, who have to rush for some other commitment. So I think we'll park the questions for today, and if time permits, we'll take it up tomorrow.
Yes, I'm sorry for exceeding my time, but the presentation was longer than I anticipated.
Very comprehensive. And only one comment I would make, that perhaps the UN team has taken it very seriously, the title of the project of taxation of digitization of digital economy, and they have not covered the brick and mortar type of economies which are sought to be covered in Pillar 1. So maybe they have taken the title very seriously, and they have confined themselves only to the digitized services. And like it was mentioned by Rajat yesterday, that the other items also may be covered up in future. And we should also not lose sight of the fact that OECD has got a team of more than 100 people, I believe, in the tax division, and UN team is not even 5. So maybe that is the reason of some of the comments we have made, that there is not much detailed analysis or not much detailed thought has gone into that. And 12B is also basically the outcome of a paper presented by one individual member, and which has been considered by the committee. So had there been such infrastructure within the UN, perhaps it would have been much more comprehensive. Anyway, time will say whether which one will come into force and when. I will thank Vikram for a very detailed analysis, and we look forward to your presentation on Pillar 2 tomorrow.
Yes, I will make it short. I promise you, I'll make it shorter. I'll stick to the time for tomorrow.
Okay. Good night, everybody. I'll see you tomorrow.
Okay.
Bye.
Thank you then. See you. Bye-bye.